The S&P 500 has returned an average of 10% per year since 1926. If you invest just $100 a month at that rate, in 40 years, you accumulate over $1.7 million. Warren Buffett famously proved the reliability of this index when he won a $1 million bet against a collection of elite hedge funds. He is such a believer in the math that he has instructed that 90% of his wife's inheritance be placed in a low-cost S&P 500 fund. Yet, for as much as we hear about it, many investors who track the index don't actually know what it is. It is a common mistake to assume this is just an automatic list of the 500 largest companies in America. The S&P 500 is a curated financial machine. To understand why it performs the way it does, we must look past the ticker symbol and see the specific criteria that keep it running. Behind the scenes, the index is governed by the S&P Index Committee. This is a group of human analysts who meet every quarter to actively decide which companies are granted entry and which are removed. To even be considered for the list, a company must be based in the US, possess a market capitalization of at least $18 billion, and trade with enough frequency to ensure high liquidity. But the most difficult hurdle is profitability. A company must prove positive earnings in its most recent quarter, and the sum of its last 4 quarters must also be positive. Take Tesla as an example. Despite its massive market size, the committee kept it out of the index until late 2020, simply because the company couldn't yet prove consistent year-long profitability. This committee serves as a quality filter, ensuring the index represents established, economically viable businesses rather than speculative trends. Once a company is in, it doesn't get an equal 1 in 500 vote. The S&P 500 uses market capitalization weighting, meaning the larger a company's total value, the more influence it has on the index's performance. This creates extreme concentration. The 10 largest companies make up over 30% of the entire index, with Apple and Microsoft commanding about 7% each. This structure benefits the investor, automatically funneling capital into the biggest winners while reducing exposure to companies losing value. However, because the S&P 500 is just a mathematical measurement, you cannot go to a brokerage and buy it directly. Instead, we use exchange-traded funds, or ETFs, like VOO, SPY, or IVV. These are real-world vehicles that track the index for almost zero cost. If you invest $10,000 in a fund like VOO, you pay just $3 a year in fees. You don't even need hundreds of dollars to start. Most brokers now allow for fractional shares, letting you buy into the index with as little as a single dollar. Buying a low-cost ETF instantly connects you to a self-adjusting system, removing the need for you to spend hours trying to pick individual winning stocks. The most effective way to fund this portfolio is through a strategy called dollar-cost averaging. By investing a fixed amount on a rigid schedule, you automatically buy fewer shares when the market is expensive and more shares when prices drop. Those drops can feel devastating in the moment. The index fell 38% in 2008 and plummeted 34% in just a few weeks during the 2020 crash. But looking at the long-term data provides a different perspective. In any rolling 20-year period in the index's history, the S&P 500 has never ended with a loss. Trying to time the market is rarely successful. The real risk to building wealth is the emotional urge to stop investing during those temporary downturns. By pairing a low-cost ETF with consistent dollar-cost averaging, investors utilize the committee's quality standards and the logic of market cap weighting to participate in the long-term growth of the U.S. economy.